Welcome to a brief video on interest rate swaps. So let's get started by first of all quickly defining what an interest rate swap would be. An interest rate swap, ladies and gentlemen. So let me write here first of all an interest rate swap. Interest rate swap would be a long-term agreement first of all. So let's understand that a long-term agreement. And because it's going to be an agreement, we will need two parties at least. So a long-term agreement between two parties, and the agreement would be about exchanging something. So let's write here exchange. So a long-term agreement between two parties to exchange. Exchange what? Exchange cash flows based on certain specified relationships. Complete this sentence and move ahead. So an interest rate swap would be a long-term agreement between two parties then to exchange cash flows based on specified or specific relationships. And if you're also familiar with what forward contracts are, then you can also understand interest rate swaps as a series, a series of forward contracts, forward contracts. And for forward contracts, we will need an underlying variable. And in this case, the underlying variable will be interest rates. So an interest rate swap could also then be understood as a series of forward contracts based on interest rates. And now when we are thinking about interest rates then, our mind can go broadly into two directions. We can think about interest rates being fixed, which will remain constant or unchanged over a certain time frame, or we can think about variable interest rates or floating interest rates. Floating slash variable rates, which of course will fluctuate as per the market forces. A very common example of a variable or a floating interest rate is the LIBOR. I'm sure you must be aware of that, which stands for the London Interbank Offer Rate. So just write that here for you, London Interbank Offer Rate. So this is just a brief description of an interest rate swap. We can see it as a series of forward contracts that are based on interest rates, or we can see it as a long-term agreement to exchange cash flows, which are based on some specific relationships. And then we have said that interest rates can be broadly of two types, fixed or floating. Ladies and gentlemen, the question then now changes to why the parties which come together for an interest rate swap would be motivated to do so. So to understand that, let us construct a simple example. Let's say that there is a bank, and let's just give it a name, Bank A. We know that all the loans that banks advance to their customers are their assets. So let's create a situation here. Let's say Bank A has recently advanced a floating rate loan. So let's just make a record of that here. They have advanced a floating rate loan. And because they've advanced this loan, they will show it as an asset on their balance sheet. Now they are happy with it because if the interest rates were to rise, that will put Bank A in a situation where their interest income would also rise with an increase in interest rate. Now, but the problem now here is what would happen if the interest rates were to fall? So if interest rates fall now, what's going to happen is that the interest income will also fall. That is the risk. To negotiate this risk, ladies and gentlemen, what the bank can do is that they can hedge their position, by taking an offsetting position to their current situation. So hedge by acquiring an offsetting position, a position which offsets their current stance. So what is their current stance? The current stance is that they have advanced a floating rate loan. They have lent some money out at a floating rate. So the opposite of that is going to be that they will go ahead and borrow some money, borrow on a floating rate basis. That would be the offsetting position. Borrow on a floating rate basis. You may ask, why not borrow on a fixed rate basis? Why not fixed? Why not fixed? What is the problem with that? The problem is that if they borrow fixed, then the interest expense that they will have to pay will remain fixed. Isn't that so? Interest expense will remain fixed, but the interest income, because that is coming from the floating rate loan, interest income will or can fall in case the market rates fall. So they should not be borrowing at a fixed rate basis. So that's something that we need to strike out here. All right, so let's say on the other hand, we have another company, company B. Let's just create a few things about it. Let's say that it's a multinational corporation and it needs funds to needs funds. Let's just say something to finance some capital project. Now, what would they want to do? How would they want to borrow if they needed borrowed funds, if they needed external financing by using debt funds? How would they like to borrow? Would they like to borrow on a fixed rate basis, or would they like to borrow on a floating rate basis? Corporate managers, ladies and gentlemen, would like more certainty than uncertainty. So therefore, they would want to borrow money on a fixed rate basis. Because if the loan is on a fixed rate basis, then they know that the interest expense is going to remain relatively stable. So here are two entities. One is Bank A here, and the other is Company B here. Both are having their own situations, own unique situations, where Bank A would want to borrow on a floating rate basis, and Company B would want to borrow on a fixed rate basis. Let's now add to this scenario some borrowing choices. So, what we have assumed so far is that Bank A wants to borrow on a floating rate basis, and Company B, Company B wants to borrow on a fixed rate basis. Now let's give them some borrowing choices. So Bank A has these possibilities open for it. So if Bank A, for example, now decides to go ahead and borrow in the fixed rate market, then it can borrow at a rate of, depending on its credit worthiness in the market, the lenders are going to offer Bank A 10% interest rate for their borrowings. And they have another choice. If they were to approach the floating rate market, then they would be able to borrow money at a rate which is equal to, let's say something, LIBOR plus, I don't know, 0.5% maybe. And then we have Company B on the other hand. Let's give Company B also some borrowing choices. If Company B decides to borrow on a fixed rate basis, which it actually wants to do, it will have to pay an interest at the rate of 11.75% per annum. And if Company B wishes to approach the floating rate market, then it can raise funds at a rate of LIBOR. Now, if you look closely, these two entities, Bank A and Bank B, they have a comparative advantage in one of the markets each. Look closely. Let's look at Bank A first. If it wants to borrow at a fixed rate basis, then they will have to pay an interest rate at the rate of 10%. So let me just change color here. Um, Let me change this to black. So 10% rate they will have to pay at a fixed rate basis. Whereas company B, if it wants to borrow on a fixed rate basis, they will have to pay 11.75%, which means that in the fixed rate market, Bank A is better at borrowing because it can borrow at a comparatively lower rate of 10%. Likewise, if you look at the floating rate market comparisons, you will see that company B can borrow at a cheaper rate of LIBOR as compared to Bank A, which would have to pay half a percentage point extra. So therefore, let's just make a quick note of that here, that um, Bank A has a comparative advantage in the fixed rate market. On the other hand, company B has an advantage in the floating rate market, right? So, what recommendation can we offer to these guys? We can say that a mutually beneficial swap can be constructed by asking Bank A to do what it is good at doing, that is, to borrow from a debt market, borrow from the debt market at a fixed rate. And we can ask company B also to do the same thing, that they should do what they are good at doing. That is, they should go ahead and borrow from the floating rate market. And after they have done so, then they can swap their liabilities. But it's very unlikely that Bank A and Company B are going to be able to contact each other directly. So what is going to happen is that we will usually need an intermediary, like maybe another bank or a financial institution, which is going to establish a connection between these two guys, Bank A and Company B. And we are going to call this intermediary, which brings them together, we are going to call that intermediary the swap dealer. And of course, the swap dealer is going to charges a commission for its services, right? That's reasonable enough. Services rendered. Okay, how are we going to construct the interest rate swap then? Let's look at some sequential steps on doing that. First of all, ladies and gentlemen, we are going to compute the potential gain from the swap. Compute the potential gain from the swap. And we are going to give it a formal term. We are going to call it the QSD. And this stands for the quality spread differential. This arises because the parties have a comparative advantage. So one party is better in one market, the other party is better in another market. So it makes sense for them to do what they can do best and then later on exchange their liabilities. Um, and to do that, we are going to first of all establish that if they do come together and enter into a swapping arrangement, then what is it that they stand to gain out of that arrangement? So for that, we are going to first of all establish the potential gain that is going to come out from this swapping arrangement, and we are calling that the quality spread differential. And out of this total potential gain that is going to be available to both parties, remember they have been brought together by an intermediary, the swap dealer. So the swap dealer is going to ask for its own cut, which we are going to subtract from this QSD. Subtract the swap dealers. So I'm just writing S for swap and D for dealer. Swap dealers commission from the total QSD, right? And now something will remain. So from the remaining QSD, so the remaining QSD can be shared. Remaining QSD can be shared between these swapping parties, right? We will use the numbers and calculate all this stuff just in a moment. I'm just writing down my thoughts here. Now, you may ask how the remaining QSD is going to be shared between the swapping parties. What is the formula to share? How much benefit should each party get? Unfortunately, folks, at this stage, there is no real mantra or a formula which will help us to decide how much gain to offer to each party. So the distribution of this gain, the remaining QSD that is going to be decided through negotiations. So both parties are going to sit at a negotiating table, and then they are going to strike out a deal of about how much benefit each party is going to be entitled to. So let's follow these 3 or 4 steps here by using the numbers and the borrowing choices that each of these parties, Bank A and Company B, have. So step one then. Step one, we are going to establish the potential gain from swap, and we decided that we are going to call it the QSD. So in order to do that, a couple of things you will need to remember. QSD is always going to be expressed as an absolute value. So there is no plus or minus sign that we need to be bothered about. Absolute value, right? How we are going to do that is just by writing down the borrowing choices of both entities here. So let's say we have Bank A here and we have Company B here. And let's write down their borrowing choices. So this is the fixed rate market. This is the floating rate market. So we are just creating a little table. So what were the borrowing choices? For Bank A, if they decided to borrow at a fixed rate basis, they would have to pay a 10% rate. And if they wanted to go ahead into the floating rate market, they would end up paying LIBOR plus 0.5%. For Company B, what choices did it have? For a fixed rate, in the fixed rate market, they would have to pay 11.75%. And in the floating rate market, they would have had to pay an interest rate equal to LIBOR. So we can clearly see that one party has an advantage in one market and the other party has an advantage in another market. So we can, in the third row here, we can simply write their relative difference. Relative difference. So it doesn't matter if you write Company B at the top here and Bank A at the bottom here, or leave it written just like I have written here, Bank A at the top and Company B at the bottom. Because if you were to turn it around, you would have 11.75 minus 10. That would give you the relative difference in the fixed rate market. If you leave it just the way I have written here, then you would have 10 minus 11.75 as the relative difference. And eventually you know that the QSD has to be an absolute value. So we are not going to be, in the end, concerned with whether our final result comes out to be negative or positive. So it doesn't matter in which order you write this. So I'm just saying let's just demarcate it a little bit and write down the relative differences. 10 minus 11.75 would give us minus 1.75%, and L plus 0.5 minus L is going to give us 0.5%, and where I say L, I mean LIBOR. So after we have noted down these relative differences, we can create a row for writing down our potential benefit from the swap, which is the quality spread differential. So what we are going to do is that we are going to write minus 1.75 here, and then we are going to say minus 0.5% from here, and that is going to give us minus 2.25. So because we are subtracting one relative difference from the other. So minus 2.25% would mean that we have an absolute value of 2.25%. So this is the total potential gain from the swap. If both these parties were to agree to a swapping arrangement after doing what they could do best, then they would stand to gain 2.25% gain from their deal. Um, Out of this gain now, if this is the QSD 2.25%, the swap dealer, so I'm going to subtract that here. So I'm saying minus what the swap dealer wants. Swap dealer wants, uh, let's just make up something. Uh, let's say 0.25% of the whole thing, which will mean then that we will have a remaining QSD, which the parties can negotiate about, remaining QSD of 2%. Right. So, for the sake of fairness, let us say that both parties decide to split the remaining gain of 2% equally amongst themselves, which will mean that we will want to give a 1% benefit to Bank A. So, I'm just writing Bank A will get a 1% benefit, and Company B will also get another 1% benefit. When I say benefit, what does it mean? Let's try and understand this. Let's talk about Bank A. On its own, what is it that Bank A can do? Bank A on its own can borrow at a floating rate of LIBOR plus 0.5%. So if I can change color, then it will be easier to appreciate that. Bank A on its own can manage to borrow at a floating rate of LIBOR plus 0.5%, right? So after the swapping arrangement is done, it should not pay more than what? On its own, it can do what? Let's make a record of that here. On its own, it can borrow at LIBOR plus 0.5%. So after the swapping arrangement is done, it should not pay more than, let's give them 1% saving, 1% benefit. They should not pay more than LIBOR minus 0.5%, right? Because this is the 1% benefit that we are giving them, the 1% saving that they will have out of the swapping arrangement. So they should, at the end of the swapping arrangement, not be paying more than LIBOR minus 0.5%. What about Company B? Company B on its own can borrow at a fixed rate of 11.75%, right? They want to borrow fixed. Remember from the motivations that we had established, Bank A wanted to borrow floating. On its own, it could manage to borrow at a floating rate of LIBOR plus 0.5%, and giving them a 1% benefit from the swap deal would mean that they would end up paying, they would be able to borrow floating as an end result, and they would end up paying 1% less than what they could manage on their own. So for Bank A, it turned out to be that if they do enter into the swapping arrangement, they will be paying LIBOR minus 0.5% as the floating rate of interest. For Company B, its motivation was that it would want to borrow on a fixed rate basis, but its competency, if I remember correctly, was more in the floating rate market. So it went ahead and borrowed at a floating rate basis, and then later it's looking to swap it with Bank A. And in doing that, they are looking at receiving a benefit of 1%. A benefit of 1% would simply mean a saving of 1% on its borrowing cost. So on its own, Company B would be able to manage to borrow on a fixed rate basis for 11.75%, right? So if they were to enter into the swapping arrangement, they should be paying actually now 1% less than that, which would be 10.75%. And also, we need to ensure that if this is done, then the swap dealer is going to get, uh, should get 0.25% on this deal. So these are our objectives. So let's proceed and see whether we can construct such an arrangement or not. To do this, ladies and gentlemen, I'm going to try and construct a little diagram for you. So I'm going to say here, if I can change color quickly. So I want to go back to black actually. So I'm saying this is Bank A here, right? And I'm saying that this is Company B here. Then I'm saying that down here somewhere is the debt market from where we can borrow funds. So just like A can approach the debt market, B can also approach the debt market. So let's make it available for B as well here, right? So this is the debt market here available for both parties. And in between A and B is the intermediary, which is the swap dealer, which is going to establish the connection between these two guys. So we said before that both parties should do what they're good at doing. So let's start with that. What is A good at doing? A had a comparative advantage in the fixed rate market, if you will remember. And if it went to the fixed rate market, it would end up paying 10% interest in the debt market. So let's say that A does exactly that, approaches the debt market. Maybe it issues a set of bonds at a coupon rate of 10%. So it is going to keep on paying an interest rate of 10% to the debt markets, to the lenders in the debt market, because it has borrowed from the debt market here. Now it approaches the swap dealer, and the swap dealer, let's say, okay, we are going to reimburse you. So I'm going to say from the swap dealer, there is a payment going into bank A, which is exactly equal to what they are paying out to the debt market. So understand these arrows as follows. Anything which comes into the box is a receipt, and anything which goes out of the box is a payment. So like for example, there is a downward arrow from A towards the debt market, which means that bank A is paying an interest rate of 10% to the debt market. Now there is an incoming arrow also into box A, which means that they are receiving 10% from the swap dealer. And from the swap dealer's perspective, there is an outgoing arrow which says 10%. So swap dealer is then making this payment because it's an outgoing arrow. But the swap dealer, spare a thought for it, is not going to do this for Bank A free of cost. It's going to ask Bank A to give something back in return. So the Bank A will be happy to oblige by paying the swap dealer LIBOR minus 0.5%. That's what we saw on the previous screen, isn't it? That after the swapping arrangement, Bank A will not agree to pay any more than LIBOR minus 0.5%. So Bank A tells the swap dealer, okay, you are reimbursing us for the 10% that we are paying out to people in the debt market. In return, we are going to pay you LIBOR minus 0.5%. Now let's turn our attention to Company B. Company B, we know from before, was good at borrowing on a floating rate basis from the debt market. So we are going to ask Company B to do just exactly that. So Company B is going to raise some money from the debt market, and because it's going to pay interest to the guys in the debt market, so there's going to be an outgoing arrow from Company B towards the debt market at the rate of LIBOR. So we write an L here. And then Company B approaches the swap dealer and they make an arrangement, and the swap dealer says, just like it told Bank A, it tells Company B, okay, whatever you are paying to the guys in the debt market, we are going to reimburse that to you. So we will give you uh, an interest rate at the rate of LIBOR on whatever the notional principal is. In return, B will have to do something, and they will be willing to pay back to the swap dealer an interest at a fixed rate of 10.75%, because they will not want to pay more than this according to the swapping arrangement. So now see, are Bank A and Company B happy in what has happened here? So let me see if I can change color again. Now look, there is an from Bank A's perspective, there is an outgoing arrow which says 10% here, right? Which means this is a payment of 10%. And also from Bank A's perspective, there is an incoming arrow at the same rate of 10%. So this outgoing of 10% is going to be cancelled against the incoming of 10%. So these two guys are cancelled out, which means that Bank A eventually ends up paying LIBOR minus 0.5%, which is what it wanted to do as per the swapping terms. From Company B's perspective, look at what is happening. Company B is paying out LIBOR to the debt market, so this is an outgoing interest, and it is receiving, there's an incoming of L as well. So this incoming of LIBOR is going to be cancelled out against the outgoing of LIBOR. So what will remain in the end? That they will be paying a fixed rate of 10.75%, and that is what they wanted as well. So Company B is happy in the swapping arrangement. Bank A is happy as well from the swapping arrangement. What about the swap dealer? Is the swap dealer happy about this? That depends on whether or not the swap dealer was able to make a 0.25 cut on this deal. So we can check that here. For swap dealer, let's just write here for swap dealer what happens. So we can make a record of the swap dealer's receipts and we can subtract the payments from it. So all incoming arrows into the SD box in the diagram are receipts. So what are the incoming arrows? Let me change color and let's see if we can highlight those incoming arrows. So this is an incoming arrow from the point of view of a swap dealer. So which means that this is one of the receipts. So let's write that. L minus 0.5% is what the swap dealer receives from A. The swap dealer also receives something from B, which is, well, see, this is an incoming arrow. This is an incoming arrow for swap dealer, and the interest rate on top of it is 10.75%. So let's add that here. So L minus zero point 0.5 plus 10.75 is what the swap dealer receives. How about its payments? Should I change color? So let me change to blue. Payments. So all outgoing arrows from the SD box are payment. So let's see what are the outgoing boxes, outgoing arrows. So this is an arrow here. This is an arrow here which is outgoing, and the interest rate applicable here is 10%. So 10% is one payment that it is making to bank A. And then what else? There's another outgoing arrow from the SD box, this one here, where the applicable interest rate is LIBOR. So we can write that here. That's LIBOR here. So all that we need to do is to calculate the net receipt here now. How are we going to do that? We are going to subtract the payments from the receipts. So we are going to say L minus 0.5 plus 10.75, and then from that minus we have 10 minus 10 plus L, right? So if we open up the brackets, we will have L minus 0.5 plus 10.75 minus 10 and minus L. So now let's see where the numbers are falling. This L is going to cancel out with this L, and then 10.75 minus 10 will leave us with 0.75. These guys here, and 0.75 minus 0.5 is going to give us 0.25%. That is exactly what the swap dealer wanted. So everybody is happy with this swapping arrangement then, right? So that's one part of understanding the swapping arrangement. Now, the question is whether this is the only correct swapping arrangement. Is this the swap the only correct swapping arrangement? And the short answer is no, because the parties could have negotiated to distribute the remaining QSD of 2% as maybe 1.5% benefit to Bank A and 0.5% benefit to Company B. This would lead us to a different but still correct swapping arrangement anyway. As long as, you should remember, as long as the distribution, whatever it is, adds up to the 2% that was available to be distributed, as long as the distribution adds up to the 2%, all swapping arrangements would be valid. Right, so let's now move on to an interest rate swapping arrangement where we do not have a swap dealer in between. So if the parties interested in an interest rate swap, for example, got lucky and met each other without a swap dealer, then they could save the dealer fee. Isn't that so? So to understand that, let's construct a fresh example where we are not going to have an interest rate, where we are not going to have a swap dealer as an intermediary. So let's construct something here. Let us say that there is a company A, and they can borrow at a fixed rate So I'm just writing in abbreviations now. Fixed rate of let's make up something 6%. And if they so choose, they can also borrow at a floating rate of maybe LIBOR plus 1%, right? And then on the other hand, we have another company, let's call it company B. Their borrowing choices are that if they decide to borrow at a fixed rate, they can get a loan at 8% fixed, or if they decide to go floating, then they can do so by borrowing at an interest rate of LIBOR plus, let me do something deliberately here, 1.5%, let's say, right? So, and their managements meet without the help of a swap dealer, and they agree to distribute any potential gain from the swap, which we know as the QSD. They agree to distribute that equally amongst them. So let's see if a mutually beneficial swap between company A and B can be constructed with these numbers or not. So now look carefully. Um, Company A has an advantage in borrowing at the fixed rate market because it can borrow at a rate of 2% less than what company B can manage. So they can borrow at 6%, where company B would have to pay 8% in the fixed rate market. So company A has an advantage there. If we look at the floating rate numbers, we again realize that company A is again better because they can manage to borrow at LIBOR plus 1%, whereas company B, if they were to borrow something similar to company A, they would have to pay a floating interest of LIBOR plus 1.5%. So in this case, we can say that instead of a comparative advantage, company A has an absolute cost advantage, right? Now, when previously when we had a comparative cost advantage, it was easy to see. We could say that whatever a particular party was good at doing, they could go ahead and do that, and then later swap it with the opposite thing. But what now? If only one party is good at doing both things, then what would be their motivation to exchange it with another party which is worse off than as compared to them in both markets, fixed rate as well as the floating rate market? So we just have to examine that by examining the situation as follows. From company A's perspective, no doubt that they have an absolute cost advantage over company B, but we are asking the question now, in which market does it have more advantage? In which market does it have more advantage? So let's write here. In the fixed rate market, in the fixed rate market, the advantage is 8 minus 6, 2%, right? And in the floating rate market, what is the advantage? So we can see this is the floating rate number for company A, and this one is for company B. So there is clearly a 0.5% difference. So the floating rate advantage is 0.5%, right? So now the question is, in which market does company A have more advantage? Naturally, you can see here it is the fixed rate market in which company A enjoys more advantage. Likewise, we can also say that company B has an absolute disadvantage in both markets, but then the question becomes, where does it have lesser disadvantage? And then it will be apparent that it has a lesser disadvantage in the floating rate market. So the recommendation here could be for A to borrow on a fixed rate basis and then swap for floating rate. So let's just make a record of that. What should A do? What should company A do? Borrow on a fixed rate basis. Why? Because it has more absolute cost advantage in this market. So borrow on a fixed rate basis and then swap for floating. Likewise, what should company B do? They will be doing the opposite. They have the least disadvantage in the floating rate market. So we are going to tell them to borrow floating borrow floating, and then later on swap for fixed. Good. So let's see how this is going to play out. Let's calculate the QSD first. Remember the steps. Step 1, let's establish the potential gain from a swapping arrangement. If there is no gain, then there is no point in proceeding further, then the story will end right here itself. So let's just write here company A and company B, and let's just note down quickly in a tabular format their borrowing choices, fixed and floating. So company A fixed is 6% and floating is L plus 1. For company B, fixed is 8% and floating is L plus 1.5, right? So which means, I'm just writing here in this row RD, which means relative difference. So let's just draw a line in between here. So here we have 6 minus 8 minus 2. And for the floating, the difference is L plus 1 minus L plus 1.5. So that is going to be minus 0.5. So this is the relative difference, and just beneath that we can write the QSD, which remember has to be an absolute value and which is arrived at by subtracting one relative difference from the other. So we are saying minus 2 minus minus 0.5. So that's going to give us minus 2 plus 0.5. So that's going to give us minus 1.5%, and we just take an absolute value of that. So 1.5% potential gain is available by swapping arrangement. This is surprising considering that company A already has an absolute cost advantage over company B in both markets, and they should be, on the face of it, not at all motivated to enter into a swapping arrangement with B at all. But as we can see, as the numbers are showing us, that if company A and B come together and enter into a swapping arrangement, they can still make some more savings, and that will be the joint savings would be to the tune of 1.5%. And we said before that the management of these companies has decided to distribute the QSD, or the benefit, potential benefit from the swap, equally amongst each other, which will mean that out of a total of 1.5%, now remember there is no swap dealer here in between, so the entire QSD is available for sharing between A and B. So which means that out of 1.5%, 0.75%, so let's just write here, 0.75%, 0.75% is available for A, and another 0.75% is available for B. So when we say available for A and B, it simply means that their borrowing costs should be reduced to the tune of 0.75% each. So what is A going to do? A is going to borrow from the debt market at a fixed rate of 6% and then later swap it for floating rate liability with company B. And in doing that, it should end up paying it will end up paying floating rate actually, so it should not end up it should not let's just look at the numbers. It should not pay more than floating. They would on their own be able to manage at a floating rate basis of LIBOR plus 1%. So after the swapping arrangement, if they are to enjoy a benefit of 0.75%, which means a saving of 0.75% on their borrowing costs, then they should end up paying no more than LIBOR plus 0.25%. So let's just make a record of that. They are going to borrow fixed, so let me change color here. So let me see if I can do that. Change to black. So company A will borrow fixed, and then later on, because it's going to swap for floating, in the end it means that it will be paying at a floating rate basis. So we are just analyzing it here that on its own, if company A was borrowing on a floating rate basis, then it would be paying LIBOR plus 1%. But because of the swapping arrangement, if we are to offer them a saving of 0.75%, so 0 minus 0.5, then after the swapping arrangement is done, they should not be paying more than LIBOR plus 0.25, right? And let's look at company B. They are going to start off the process by borrowing at a floating rate basis because that is where they have least cost disadvantage. So they will start by borrowing on a floating rate basis and then later on swap with A for fixed. So in the end, after everything is said and done, company B is going to end up paying at a fixed rate basis. Now let's see if company B went ahead and borrowed at a fixed rate basis on its own, then it would be paying 8%. But after the swapping deal is done and we offer them a benefit or a saving of 0.75%, then they should not be paying eventually at the end of everything not more than 7.25%. So these are the numbers that are going to guide us when we prepare that diagram. So LIBOR plus 0.25% is the maximum that A would want to pay, and 7.25% is the maximum that B would want to pay. So let's try and construct a swapping diagram, this time without a swap dealer, and see how it plays out. So let's say we have company A here, and it has an option to borrow money from the debt market. So the debt market exists here. Likewise, there is company B here, and company B, just like company A, also has access to the debt market, right? So what did we say on the previous screen? That company A has an absolute cost advantage. So let's go back there and see. Company A has an absolute cost advantage in the fixed rate market as well as in the floating rate market, but the greater of these benefits comes from the fixed rate market where they are better off in comparison to company B to the tune of 2%. In the floating rate market, they are better off as compared to company B to the tune of only 0.5%. So whichever market they are more better in, that is where they are going to go to start the process. So company A is going to go to the debt market and maybe issue bonds or do something or take out a loan at a rate of 6% from the debt market. So if they take out a loan at a rate of 6% from the debt market, then there is going to be an outgoing arrow from A towards the debt market, which says that we are making a 6% payment to the lenders in the debt market. And likewise, company B is going to start off the process by borrowing from the debt market on a floating rate basis, where it will borrow some money and pay out an interest at the rate of LIBOR plus 1.5%. Now A wants to swap with B and B wants to swap with A. So A tells B, let's say that, look, I am going to give you on a certain principle, on a notional principle, which is equal for both parties, let's say $1,000,000. So when we are calculating 6% or LIBOR plus 1.5% or any percentage, we have to apply the percentage on a certain principle. And for both parties, that principle has to be equal. Otherwise, no swapping arrangement will be equal to work. So we say that we just construct an elusive or principle, illustrative principle, and we can call that the notional principle. So let's say maybe $1,000,000 or $10,000 or whatever. We are going to pay you an interest. Company A says this to B. We are going to pay you a floating rate of LIBOR plus 0.25%. Because remember, if we go back to the previous screen, LIBOR plus 0.25% is the maximum that they would want to pay. So they say, okay, we are going to pay you LIBOR plus 0.25%. In return, you give us something on a fixed rate basis. So B is going to pay something. B will pay how much to A? That is the question that we need to uh, find a solution to. How much should B pay to A so that its eventual payment is no more than 7.25%? Because see, A is happy. They are offering to pay LIBOR plus 0.25%. And if we go back to the previous screen, you will see that this is the maximum they wanted to pay. So they are happy paying LIBOR plus 0.25%. Now the question is, how much should B in return pay to A so that their total payment does not exceed this 7.25%? I'm saying the total payment should not exceed 7.25%. And when I say total payment, uh, think about it for a moment. B is paying out an interest at LIBOR plus 1.5% to the debt market. It is also receiving LIBOR plus 0.25% from A. So now how much should B pay to A so that the net result ends up to be 7.25% payment? So that's what we need to find out. So one way of doing that is, let's consider company A. Let's just write down whatever we have written in arrows, howsoever we have labeled the arrows, let's just write them down as an equation. Company A is paying 6%, and we are going to call this net payment from A's perspective. So let's just write that down. 6% is what they pay to the debt market, right? This 6% here. Then they pay LIBOR plus 0.25% to B, which is this item here. And then because we are talking about net payment will mean that out of the payments that company A is making, they should subtract whatever they are receiving. That's the meaning of the word net. That from your payments, if you subtract the receipts, then you will be left with your net payments. So what they are going to receive? They are going to receive something. So I'm going to write R for receipt, and in the subscript I'm going to write B because they are going to receive something from B, which is this part here, which we are trying to figure out. So 6% paid out to the debt market, LIBOR plus 0.25 paid out to B, minus any receipt from B. When that all is done, the end result should be, we know it should not exceed, from A's perspective, LIBOR plus 0.25%. So from this equation, we can simply figure out what the value of RB is going to be. So if we change color here and try to cancel out a few things, L is here and L is on the other side cancelled. 0.25% is here and plus 0.25% is here as well on the other side, so cancelled. So what do we have left? 6% is equal to RB minus RB. 6% minus RB, sorry, because I just made a mess of all of this. 6% minus RB, and on the other side it will be 0, so which will mean 6% is equal to RB. So this means that B will pay here 6% to A. So if we were to look at this swapping arrangement in a neater way, we would say A is going to pay out 6% to the debt market. It is going to pay L plus 0.25% to B. In return, B is going to pay them 6%, and B has borrowed from the debt market at a rate of LIBOR plus 1.5%. Now, if you examine this, if we change color, you will see that from A's perspective, this is outgoing 6%, and this is incoming 6%. So both these sixes can be cancelled, and eventually they end up paying only LIBOR plus 0.25%. What about B? Are they happy with the arrangement also or not? What is happening? They are receiving what? From B's point of view, let's just write their situation here. I'm just writing R for receipts. So what are they receiving? All incoming arrows to B are their receipts. So they are receiving LIBOR plus 0.25% from A. And what they are paying, I'm writing P for payments. What are they paying? They are paying 6% to A, and they are also paying LIBOR plus 1.5% to the debt market, right? So what is their net situation? For that, we can do receipts minus payments. So let's just write that LIBOR plus 0.25. I'm omitting the percentage sign to just save some space for myself. LIBOR plus 0.25, and from this we need to subtract 6 plus L plus 1.5. So if we open up the brackets, we will see LIBOR plus 0.25 minus 6 minus L minus 1.5, right? And if you solve this now, so if we can change color again quickly and come back to red, I'm seeing that there is a plus L and there's a negative L which can be cancelled out, and then we have some numbers left with us. 0.25 minus 6 and then minus 1.5. If you solve this, you are going to come up with minus 7.25%. And this negative sign simply implies that money is being paid out. This signifies payment. That is what B wanted as well. They wanted to pay no more than 7.25%. So that's exactly what B wanted. So they are happy as well. And A was already happy with the arrangement. So that is pretty much it with as far as an interest rate swap without a swap dealer is concerned. So in this brief video, which is not so brief actually, it's running close to an hour now, we have seen what an interest rate swap is, and then we have seen that it's a long-term agreement between two parties which will exchange cash flows based on some specified relationships. We also saw that if we are aware of what forward contracts are, then an interest rate swap can be seen as a series of forward contracts based on interest rates. And when we thought about interest rates, we saw that they could be broadly classified into fixed interest rates and floating interest rates. And then we went on to see how Bank A and Company B had differing motivations on how to borrow, on what basis to borrow. Bank A had a motivation to borrow on a floating rate basis, and Company B had a motivation to borrow on a fixed rate basis. And then we went on to see how a mutually satisfying swapping arrangement could be arrived at between these two parties with the help of a swap dealer. And in the second example, we saw where two companies, Company A and B, came together in a mutually beneficial swapping arrangement in spite of the fact that Company A had an absolute cost advantage in both uh, type of markets, fixed as well as floating. So, ladies and gentlemen, that is all there is from my side for this little topic. I hope you enjoyed it and it helped you gain a little bit understanding on interest rate swaps. Take good care of yourselves, guys. Bye bye.